Okay, in this video we're just going to have a bit of a look at how to calculate your income and how much tax you would pay on that income. Just a bit of a revision. You should have done this in your assignment, as well as looking at some different types of loans and how to calculate the interest and principal component of a loan. Before we get started, just be mindful that you always want a higher interest rate on your savings if inflation is high. Because if you say invest $10,000 into a bank account and inflation's really high, after 1 year that $10,000 is not really worth as much because prices have increased. So let's say prices have doubled, that $10,000 is really now only worth $5,000. Or if prices had gone up by 50%, it's now worth less than what it was. So you will demand a higher interest rate on your savings when inflation is high to compensate yourself for the fact that now your money is not worth as much. So in terms of the progressive income tax system, you will have seen these tax brackets before. What I just want to discuss is how you calculate your tax based on these income tax brackets. Just be mindful that your total income includes anything you earn from wages, rent, dividends, interest, and any fringe benefits that you receive. So first of all, we refer to the term pay-as-you-go withholding tax, which is basically a system where you get taxed every single week on your income. And the idea of that is so you don't have to just pay a lump sum of tax to the government at the end of the year. So every time you earn income, let's say I earned $1,000 a week, you would pay your tax throughout the year. As you go, you would pay $300, for example, to the government, so that you don't owe the government one big lump sum of tax at the end of the year. Then at the end of the financial year, what they will do is employees will fill out this thing called a pay-as-you-go summary, and that will lodge that to the Australian Tax Office, and will work out whether you've paid too much tax throughout the year, or you didn't decide to pay enough tax throughout the year. So if you paid too much tax every week than you should have based on our progressive tax system, you will get a refund at the end of the year. But if you've paid too little tax throughout the year, then you may have to pay money to the Australian Tax Office at the end of the year to account for the fact that you haven't paid enough throughout the year. So for example, let's say a person earns $50,000. To work out how much tax they would pay. Okay, first of all, you don't pay any tax on the first $18,200. But then what you'll do, if looking at this brackets, that what this means is that this $3,572 means that for the first $37,000, you will pay $3,572 for that. Then you've got to work out how much tax you will pay on the rest of your money, so the extra $13,000 you've earned above that tax bracket. And for that $13,000, so the $50,000 that you earned minus the $37,000, you will pay a tax at a rate of 32.5 cents per dollar. So to work out your total tax, it's the $3,572, which is your tax on your first $37,000, plus 0.325 times the $13,000 you earned above $50,000. And then you end up paying a total tax of $7,797. If you were to earn $90,000, what you would do is you go back to these tax brackets. Again, if you earn $80,000, you pay $17,547 in tax. Then you've got to work out how much tax you'll pay in the extra $10,000 that you've earned. So for that extra $10,000, you'll pay 37 cents per dollar. So to work it out, you'll end up having $17,547 plus 37 cents times that $10,000. And therefore you will get a figure of $21,247. A slightly harder question is when you have to work out the income first and then work out how much tax you will pay. So let's say you've got Paul. Paul is on a salary of $185,000. Plus he gets a holiday of $5,000 from his workplace. He also has invested $500,000 in the bank, which he earns 6% per annum interest per year. And he also gets dividends of $200 a fortnight. So before we work out how much tax he has to pay, we've got to work out what his total income is. So to do that, we start with the $185,000, which is this figure here, which is his wage. Then plus the $5,000 in fringe benefits. Now with this $500,000 he has in the bank, that is not income. That is his wealth at this point in time in terms of his savings. What we want to work out is how much income he's earning, and the income that he's earning is the interest that he earns on that bank account. So he has $500,000 in the bank. He's earning interest of 6%. So you do 500,000 times 0.06, so he will be earning around $30,000 in interest on that bank account. And then his dividends, it is $200 a fortnight, and there's 26 fortnights in a year, so his total from dividends would be 200 times 26. So you need to add up each of these four components, and he ends up with a gross income of $225,200. So this figure plus his interest plus this don't add the $500,000. It's just the interest that he receives that he gets as part of his income. Then to work out his tax, if you go back to your tax brackets, okay, if you earn $180,000, you'll pay $54,547 in tax. So what you will do is you will put that $54,547. Then we add 45 cents per dollar, because that's what you pay in this tax bracket, times by the $45,200 that he earns above $180,000. So his total tax ends up being $74,887, which gives him a disposable income of $150,313. Okay, just be mindful, and I'll go through this relatively quickly because we talked about this in class. Secured and unsecured loans. So secured loans means that if you default on your loan, the bank gets your assets. So like a housing loan or a mortgage, the bank gets access to your house. If you default a car loan, the banks get access to your car. Credit card loans are unsecured loans because the bank doesn't get any collateral or any asset when you don't pay that off. So secured loan means that there is some asset that they get. So I'll just flick past that. Secured loans means they offer a lower interest rate than unsecured loans because the bank gets access to your car or your home and has that security that if you don't repay your loan, they get some asset as well. With unsecured loans, you don't have to put up any asset, but the interest rate is usually higher. To get an unsecured loan, it can often be a lot harder, and you must convince the bank that you are able to repay the loan because they don't want to be lending to people that can't pay back their money, and because they're not going to get anything out of it. In terms of some other key definitions, the term is basically just another word for saying how long it takes you to repay your loan in full. The principal is the amount that you borrow at the start. And then you've got two types of interest rate, a fixed interest rate and a variable interest rate. A fixed interest rate is an interest rate that doesn't change throughout the life of the loan. So the loan, if you take out a loan at a 5% fixed interest rate, the interest rate's 5% throughout your whole loan. If you take a variable interest rate up, that interest rate can go up and down. So you might take out a loan at an interest rate of 4%, and then a year later your mortgage might have an interest rate of 6% or 8%, or it may have gone down to 2%. So the interest rate can vary along the life of the loan. And finally, when you're calculating this, you will need to do this in your test. So if you have to calculate how much interest you're going to pay on your loan, and you're getting an 8% interest rate with repayments of $12,000 per year. To work out your repayments, you've got your principal at the start is $50,000. Your yearly repayments are $12,000. You've been given that. To work out the interest component in the first year, it's your principal, which is $50,000 times by 8%. So therefore, your interest will be $4,000, and your principal component is basically your yearly repayment minus the interest. So at the end of the year, you'll have $38,000 remaining on your loan. In the second year, I'll just show this in this little slide. If you basically have $38,000, to work out your interest component, it would be $38,000 times by 0.08. Okay, so that will give you a figure. If I just grab our calculator, you'll get a figure of 38,000 times by 0.08. So you'll get a figure of 3,040 as your interest component. If you're calculating the amount that you're going to pay off in principal, it's therefore 12,000 minus your repayment in that year, which will give you a figure of 8,960. Okay, to work out your principal at the end of the year, it's 38,000 minus 8,960. Okay, which will, if we plug it into our calculator, will be 38,000 minus 8,960, which gives you a figure of 29,040. And then you use this figure as your principal for the next year. And then to work out your interest, you will do 0.08 times by this figure here, the 29,040 figure. And then your principal, again, will be the 12,000 minus whatever you get in this column. When you get to your last year, let's say I had, $2,000 left on my loan in the last year. What you need to work out is first work out your interest component. So if I had $2,000 left, it would be 2,000 times by 0.08, so it'd be 160, which would make my final repayment in the last year $2,160, because I'm going to pay off my whole loan. So my principal component will be 2,000, but I also have to pay an extra 160 for that interest in that year as well. So when you finish off, you need to calculate the total in this column, and that should be equal to $50,000 because that's the life of your loan. And then you need to work out your interest component, which let's say it's $12,000. And then these two things combined will be your total repayment on your loan. Thanks for listening.